they were going to do. Because the curve's still lagging. The curve still has room to move to the absolutes. Does that make sense to everybody? So when you're studying the absolutes, this is why we study the absolutes, because if I'm trying to understand how much room the curve has left in it, take away the bond yields for a second so that we understand this relationship. If I try and understand the curve absolutes, right? If I try and understand that relationship, I'm always asking the question, how much room has the curve got left in it? I know I can see the bond relationship to the curve. The question I've got is, how much room has the curve got? That's what we use the absolutes for, isn't it? We want to know how much room we've got left. This is the whole point about the absolutes in the first place, is have we used up all the space? The absolutes is like a bubble. Unless we were to move into an inverted curve world, the absolutes is like a bubble. There's only so much space for the markets to move inside of or outside of. And obviously, if they relieve that pressure, then it allows the curve to relax a little bit. So when I start seeing that the absolutes have plenty of room, or have provided the curve with plenty of room, then it becomes pretty obvious about what the trade could be. We can recognize that the curve's got plenty of, well, it's not got plenty of room. Let's not be over-exaggerating this, but that has definitely got room. Now, obviously, you might say, how do you know that's got room? How do you know it's got room? Because I can scroll backwards, can I? I've got this ability to scroll backwards, and I can look at the curve itself, and I can look at the shape of where it is. I can look at the previous valuations, for example, on the curve, and I can look at where the shape of the absolutes are, and I can ask, has it got any room? Well, the answer is, the curve's got an awful lot of room. If the curve's got an awful lot of room, remember this is the curve inverted. It's, you know, if you want to do it as a positive correlation, do it as a positive correlation, but they're going to start trampling on each other rather than, it's not going to be as, I don't think it's going to be as clear a picture. So when I look at the curve shape, I'm always asking the question, has the curve got any room to move? If the answer is yes, I know that the curve has a reasonable amount of steepness that's available to it. So in other words, that tells me that the yield has at the back end of the curve, the yield has room to move at the back end of the curve. The difference between these stories becomes a possible trade narrative, doesn't it? The difference between these two ideas becomes a possible trade narrative. And as a result, we can already start to recognize that the yield is biddable down at these bottom edges. So if we look at the bottom edges, we can buy yield against that. And if the curve continues to lag the absolutes, the curve has additional steepness left in it, which leaves the bond exposed to further correction to the downside. I can leave that bond in place as a short trade and let it ride. Is that the way everybody's reading this absolutes at the moment for this from yesterday's classroom? Is that how everybody's kind of getting this idea? Is everybody seeing that? The more space the curve has against the absolutes, the more room we have as a bond trader for the bond to work. And if we've got more room to work, we can see, for example, that the absolutes have made a new lower low. The curve is nowhere near the lower low. So the curve still has some space to move, hasn't it? The curve still has space. Oops, what have I done? the curve still has space to move here, doesn't it? So if the curve overtakes, what's going to happen? The yield has gone too far. The blue line is the curve, absolutely, Reeve. The red, so I'm comparing the amount of curve that's, the amount of space that the curve's got against the absolutes, yeah? So if the curve has got a lot of space against the absolutes, that means that the yield has a lot of space to move at the back end. So for example, we can see that whilst the curve is steepening here on this chart, which means it's flattening in real time, because obviously I've got it inverted for the purposes of clarity, whether it confuses people or not. It's the way I like to look at it. So when I look at the curve and there's space for the curve to flatten down, there's space for the curve to drop here, that's a buy on yields. If there's space for the curve to drop, it's a buy on yields. So if I get rid of all my arrows, if I get rid of all these lines, I can compare them to the longer term. I can compare it to the short term. I can compare it from point to point. I can try and look for value. So when we think about that narrative, we can obviously look at this narrative here, and I can say, well, there's the curve. It's about this, roughly about the same. And I can look at the shape of the absolutes. So we can look at the shape of the absolutes, and we can look at the shape of, well, we can take it from anywhere for the curve. So I can take the curve from there, it doesn't matter. I can take the curve from here, it doesn't matter. And the reason why it doesn't matter is because they're still in the same direction, the same slope. So when we look at this shape, my big question, my huge question is, have I got room for the curve to steepen? Now this is a real steepening, which means this line's going to fall. If the blue line is at a top edge, that means the answer is yes. There's room for the curve to steepen, blue line to fall. If I look in the background into this area here, for example, we can ask the question here, for example, have I got room for the curve to steepen? The answer is yes, absolutely. So if I've got room for the curve to steepen, I can obviously look to buy yields to take advantage of the steepening of the curve. And obviously in that situation, I could buy yields at that point and I'm almost guaranteed to make some money. So I could buy yields there and I can almost guarantee I'm going to make some cash. And you can see that the yield rises quite nicely at that stage. Now, obviously the curve changes against the absolutes. We start to see the curve dropping off a little bit. And then what happens, of course, is the curve rises again, but this time the absolute starts getting squeezed, and that's the end of the trade. At that stage, that's the end of the trade. And we can see actually the other side starts to work. On this other side here, we can start to see this dropping off, which starts to put me into a position of selling yields, because now the curve has got more downside. So obviously in that situation there, I've got now more downside for the curve, which means any uptick in yields is going to be a sellable opportunity. I'm going to take advantage of that and work into selling higher prices on the yields, buying bonds, of course. So obviously what happens is that yield drops quite nicely. And it goes backwards and forwards because obviously this is all part of the same jigsaw puzzle, isn't it? These are all part of the same jigsaw puzzle. But what I've got to try and do now is I've got to try and look at these in relative value terms and try and figure out whether the curve's got any room. The curve is the blue line. The absolutes is the red line. Anytime the blue line's got space to move, yields have got space to move. So I can draw these areas and I can start analyzing each of these. So for example, if I wanted to sell the blue line, let's just mark off the sells on the blue line. So I could sell the blue line here easily. I could obviously sell the blue line here easily. I could sell the blue line here. Now, obviously, that looks like a horror story. All of these look quite bad because obviously we get actually an adjustment in the absolutes rather than an adjustment in the curve. I could sell the blue line here. I could sell the blue line actually at just about all of these three locations, but obviously that means that I'm going to be buying yields at lower levels. So if these are all sells, on the curve for the blue line, that means I'm buying steepeners. If I'm buying the market steepen, I'm expecting yields to be going up, right? I must be expecting yields to be rising. So every single one of these could be a buy on yields to rise. So when I look at those trades, if I took each one of those, as I said, one of them was a horror story because we saw what happened to the absolutes. That changed not the curve. We could have bought here. We got a very nice rise here. We could have bought here. We got a reasonable rise here. This is the horror story. Because if you bought here, you got squeezed on that trade very, very aggressively. And obviously the final one was this one here. You got that beautiful ride north. A stunning, stunning, stunning trade based on that absolute storyline of the yields against the absolutes. So again, when we look at the yields against the absolutes, again in that situation, we can start to recognize why certain trades didn't work, like this trade here. Well, we can tell why that trade didn't work. Because the curve never steepened. The absolutes got squeezed right there. Now, this is obviously a challenge, isn't it? Because you say, well, does the blue line lead the red line higher? In other words, does a flatter curve lead the absolutes into oblivion, basically? Does a flattening precede the movement in the absolutes? How does it work? Well, the only way you can answer that question is to analyze it in a longer term narrative. And obviously we've got other lines. We can add oil prices. We can add oil prices to this, can't we? So when we look at this overall picture, if I'm looking at absolutes, the red line, I want to know whether the red line leads the blue line or whether the blue line leads the red line. And unfortunately, yet again, the answer isn't crystal clear because it depends what's happening on things like inflation break-evens. That's why we build a multiple attack into this trade rather than a single angle. So for example, if I was to look at the top edge up here, we could ask the question, well, obviously the curve is way too flat here. Way too flat for what's happening in the absolutes. The absolutes are going crazy, brilliant to the downside. So this curve is way too flat. If the curve is way too flat, what's going to happen to yields? Yields will be almost guaranteed to be going higher. Brilliant. What a brilliant trade opportunity. So when we see that idea developing, we can see that that trade resulted in one of the biggest rises in yields we've seen for weeks. Crazy good trade outcome on the yield itself. Crazy good trade. And that's because we started to see the drive on the absolutes. It wasn't just the curve that was driving, it was the absolutes that were driving. So there's a starting point for a clue, isn't it? There's a starting point for a clue. When the absolutes are driving, they have more confidence in the yield. If the yield curve is driving, we've got less confidence in what's happening in the absolutes. So one of the things that we start to understand is this. The driving market, and this comes back to a question in a discussion we've had about things like the spaghetti charts. What do we say about the spaghetti charts? Never fade a leader. Yeah. So when we're talking about the spaghettis, one of the ideas that we talked about before was we'd never fade the leader. And obviously the problem we've got is that we've got two lines going. And sometimes you see that line moving. Because you see that line moving, if you look at that line as a single value line for this market here, which might be your traded market, whatever it is, whether it's oil or equities, whether it's bonds or the curve, if you're looking at a value line for that going there, you're going to be automatically assuming, of course, that the trade is going to be in this market. Well, that's right. That's where it would be. Unfortunately, if you trade this market, now this is where the challenge is, because if the blue market, which I've changed the bottom to, if the blue market is the market you're trading, then obviously that movement higher is going to be a buy on your blue market. But if the market you're trading is the black market, then obviously what you're going to be starting to look at is you're going to start saying to yourself, the value is definitely lower for me as a sell, so I'm going to start selling in here. Well, that's a mistake, isn't it? That has got to be a mistake, because, well, how do you know that that's a sell? I mean, it's going up. What the hell are you trying to do? This idea of lead and lag is incredibly important. This idea of the market that's actually the first to move, the leaders. You don't fade a leader. You don't fade a leader. The only time you fade a leader is if the lag markets, the market that is lagging behind, starts to move off in the opposite direction. Then you start looking at that leader and saying, wait a second, this leader has nobody following. So if this leader's got nobody following, then obviously we can start to change our mind about what's going on, because obviously what could happen is this trade should be a buy on the blue line, not a sell on the black line. So this trade should be a buy in the blue line. The blue line respondees. The blue line responds beautifully. If the blue line were to then double back, then we've got a possible trade here on the black line, haven't we? Now we've got a trade on the black line. Whatever the black line may well be, we've now got a possible play here to sell the black line. In other words, value is about the driver. We've talked about this when we talked about the fundamentals the other day, and Ian made a mention about whatever the market that's driving is the market that's driving. Whatever the market that's driving is driving. Well, that should be pretty obvious. And yet, we're still at that point sometimes where we're still getting tripped up because it's a difficult thing to do. It's a difficult thing to do, isn't it? We don't know which one's driving unless we see it actually giving us a very, very clear signal. Flat lines versus diagonal lines. This is what we should always remember. If I draw a black line here and I draw a blue line, what's the trade? Is it a sell on the blue line or a buy on the black line? It should actually be pretty obvious. It's a buy on the black line. It's not a sell on the blue line, it's a buy on the black line. Why is that the case? Because the market that's catching bids on the face of it is the blue line. Now, maybe it doesn't catch bids, but on the face of it, the blue line is the market that's catching bids. If the blue line then does this, what is a trade? Well, there isn't one. There isn't one. It's not a buy on the black line and it's not a sell on the blue line because we don't know what else is happening. At the moment, the only trade would still be, if you were doing anything on a macro scale basis, the only trade is still to be buying the black line at this point. But obviously, if that trade changes, if we start seeing some pressure coming in here, what's the trade now? Well, the only trade is now to be short the blue line, right? We're going to be working back into this deal here because that's where the trade is at. So it doesn't mean what we think it sometimes means. So in other words, it's very important for me to see, for example, the curve. I don't want to see the curve steepening because of a drop in bond prices. I want to see the curve steepening as bond prices basically make a flat line, because then I've got a real trade. I don't want to see a crack spread trade rising and oil prices falling, because it's not giving me enough evidence of where the trade is. If the oil price is flat, it makes it very easy for me to make a very, very simple read. A flat line against a rising line or a flat line against a falling line makes life an awful lot easier for me. So in other words, if I'm looking at the curve, a movement higher in the curve isn't giving me much of a read against the absolutes. A movement lower in the absolutes is giving me a possible read on the curve, so I can start using that information. So I can start looking at the relative amount of movement. Now, it doesn't mean we can't use. It just means we've got to be more cautious when we use the extra value we get on the curve. You've just got to be cautious, guys, because that might be the leader. So if we do have a movement, for example, if we have a movement on the blue line, if we have a second way of looking at the blue line or a third way of looking at the blue line, we might be able to look at that and say, well, we've got another value line that's doing this and another value line that's doing that. Well, now that calls into question either trade. Because obviously this black trade here looks like the right trade. Now the blue line from this early point possibly could be the sell trade. So that takes away that, or it adds to it, it takes away some of the indecision and it adds to a little bit more clarity, because we can obviously start analyzing the shape of the, and we can start analyzing the shape of the absolutes against something like the inflation break-evens, so that we can see whether the inflation break-evens agree with what's happening inside the curve. If the inflation break-evens are getting murdered, we would expect a curve flattener. If the curve is obviously very steep against the absolutes and it's also very steep against the inflation break-evens, is there any debate? Absolutely not. If the curve is very steep against the absolutes and the curve is very steep against the inflation break-evens, and we can see that the real yields are massively overpriced, is there any debate? No. The debate has been reduced to nothing, zero. The trade will be a long bond trade narrative. So we can build the picture out. Instead of just relying on a blue line, red line, black line, orange line moving up and down, we can move this debate forward into looking at the relationship of the various aspects. And that's what I've said many times, is simplify the charts at your peril. And I'm not talking about overcomplicating your charts so you can't make a decision. What I'm saying is put enough information on your charts to make an accurate decision that you can actually be comfortable with and rely on. If you just have two lines, which one's right and which one's wrong, we don't know the answer to that question. So when we look at a chart, when we look at the relationship here of absolutes versus curve, we can see the curve is way too expensive up at the top edge. Remember, this is curve inverted for bond prices. So this is way too expensive. In other words, yields are way too low, way too low. So if I look at yields that are way too low, what else might be in play here? What else might be something that we could think about? Well, perhaps it's got something to do with volatilities. If yields are too low, that would suggest that volatilities are maybe very, very high. So if volatilities were very low, well, we've got a possible play here, right? We need to obviously try and kind of understand this, because this is a very, very complicated concept. The multiple different lines and how you develop